Welcome. My name is Michael Staten. I'm a professor in the Norton School of Family and Consumer Sciences at the University of Arizona, and I'm also the director of the Take Charge America Institute for Consumer Financial Education and Research here at the university. You're viewing an edited version of a webinar that we hosted on September 29, 2011 on the topic of how the new credit score disclosure rules will affect you. Let's begin with a word or two about who we are. The Take Charge America Institute's primary mission is to create research-based financial education outreach programs for consumers, especially for youth. Our largest outreach program is the Family Economics and Financial Education Project, or FEFE. FEFE provides educators with a comprehensive set of curriculum materials free of charge and help in building skills and confidence to effectively teach family finance. In short, we want to make it easier for you as teachers to put financial education into your classrooms, whether you're teaching an entire course in personal finance or just one or two lessons. This webinar will include an extended discussion of credit scoring and the new regulations that will lead to disclosures of millions of credit scores to consumers across the country. Please follow our newsletters because we expect to offer you additional webinars through the academic year, and this should prove to be a useful resource for you. We'll get started with the meat of the webinar here shortly, but we also have another goal today, and that's to provide you with resources related to credit reporting and credit scores that you can immediately apply into your classroom. So I'd like to introduce you to my co-presenter, Shelly Stanton. Shelly is one of our FEFE National Master Educators who works with our team on a daily basis to design curriculum and training resources. Shelly's a nationally board-certified business teacher from Billings, Montana. And so, Shelly, I'll turn it over to you.
All right. Thanks, Dr. Staten. I am just thrilled and honored to discuss the FEFE curriculum, which I use every day in my classes of personal finance, accounting, marketing, and a computer skills course. FEFE offers a variety of lessons in the credit unit, and today I will highlight parts of the Understanding Your Credit Report, which is a Take Charge of Your Finances lesson. We will have time to just briefly discuss parts of one activity and a few assessments, so please reference the lesson plan for further details. And remember that all lesson plans can be downloaded for free on the FEFE website. Students often come to the classroom having heard or seen the topic of credit reports and scores in the media, but they usually don't know much about either of them, or at least they don't know a lot of facts about them. The news headline activity is a great way to kick off the credit report facilitation by allowing students a safe area to communicate their thoughts. The activity has students read, analyze, and comment on a timely article about credit reports. So let's see how this actually looks in the classroom. Tiff?
Hi, my name is Shelly Stanton, and today I'd like to talk to you about how to set up the anticipatory option number 2 in credit reports, Understanding Your Credit Reports, number 1.4.2. When I set up for this activity, I start by grabbing big pieces of butcher paper, as you can see here, and then selecting some articles related to credit reports. For today's articles, I actually hopped on the FEFE Facebook group, and there were some great articles I was able to just pull off of there. Also, when I set up for the activity, since I have multiple classes that go back to back where I have to teach personal finance, I go ahead and stack sheets on top of each other so that at the end of the period I can just rip this off and be ready for the next go-round of the news headline anticipatory. After I explain the directions of how we're going to do the news headline article, then I will give each student a colored marker and we'll go ahead and start.
For today's facilitation, the students were able to select their groups and they moved around the room. There are 7 different groups, although you can only see 4 in the video. Before the group activity occurred, I gave instructions to all students. The instructions included start the graffiti board by reading the article silently to yourself, and then start making comments. I also listed the directions on the whiteboard. Along with the directions, I listed thinking prompts that were in the lesson plan. Those thinking prompts were, I wonder, this reminds me of, I disagree with this passage because, I don't understand because, this is important because. For this activity, I sometimes set a time limit and sometimes I don't. With this group of students, I decided to just watch and see how the flow of the activity goes. To start out, as you can see, there's very little writing and students are mostly thinking. And as this process continues, they really start writing and commenting on each other's graffiti boards, and it gets pretty exciting.
Okay, guys, so just in a minute, I'd like someone from your group to share kind of the main points from your article, because everyone actually had different articles. So if you could select someone who gets
7 things students need to know about credit cards, just kind of the hidden things behind. The first one is items purchased on a credit card are not free.
Obviously. Is that where the job was?
Yeah.
There you wrote job? Okay, good.
And then credit cards can be used for emergencies, like as a start off, you need to have guidelines. Credit cards are not all the same. You need to do your research and ask questions before you choose one.
Yeah, ask lots of questions. I like that. Whoever wrote that question.
Number 4 is cards are designed for students. How do you find reliable information on credit cards? You need to research and know about it. Number 5 is you'll now have a credit report, so make sure you know what's on it and keep updated.
All right. So, as you can see from the activity, it's a great method to introduce the topic of credit history. While students are reading and commenting, which I call graffiti, they are creating connections between credit reports or scores in their life. They also utilize print media, which offers the opportunity for students to evaluate source validity. During the activity, students receive peer reinforcement and correction in a constructive manner. And 2 of my favorite parts of this anticipatory set are that every student has equal opportunity to participate because they all have a marker, and students are intrigued to learn more about the content of credit reports. Speaking of content, Dr. Staten, can you share what we need to know about credit rules and disclosures?
Well, I certainly can, Shelly. Thanks very much. Okay, let's dive into a discussion of what is coming in terms of new disclosures in the world of credit reports and credit scores. Let me give you a sense of how I want to spend the next few minutes here, a little outline of the concepts that we're going to cover. Let's start with just a reminder about why a good credit score is more important than ever and what you can do to manage it. Then we'll progress to just a quick primer on credit scoring. What is a credit score? How is it used? And a little bit of background on how you might explain that to somebody else. Want to go through a little walkthrough of why consumers have more than one credit score. Lots of folks are aware of the FICO score that's out there, but we want to make the point that there are many other scores too. And with the new score regulations and disclosure rules that we'll talk about later, you're going to find that there may be many types of scores that are disclosed to consumers. So I want to make sure that everybody's clear as to why there are so many scores on one person. And we'll talk about those new regulations and what they're going to mean for consumers, and talk a little bit about why financial educators, I think, need to know more about credit scores than they ever have before in order to be able to be prepared to answer the questions that are going to be coming. So that's the outline for the next few minutes. All right. So the reminder, good credit score is more important now than it ever has been before. First of all, just from reading the headlines of the last 2 to 3 years, we know the following. Lenders are pulling up the ladder, so to speak. They're backing away from higher risk applicants. A lot of this is a direct result of having been burned so badly in the wake of the global financial crisis in 2008 and the resulting recession, a very deep and sharp recession in 2009 and 2010. Loan losses spiraled at lenders. They found that they'd taken on way too much risk in the boom years leading up to the financial crisis, and now they're pulling back. And as often happens through these cycles, they tend to pull back very sharply and probably pull back too much. So we know that it's harder to get a mortgage these days. We know that they're requiring higher down payments. They've raised the credit score minimum required for qualifying for a loan. Many people can't refinance their mortgage loans at all. We know that it's tougher to get credit cards these days, and especially tougher if you're a young person or you have limited credit history. So for all these reasons, it's very important to be aware of your credit score and the opportunities that it makes available to you, and to manage that as best you can, and certainly to find any information that's incorrect in your credit report that may be leading to a score that's lower than it should be. Well, that's reason number one for why scores are more important. Reason number two, and this has been happening for the last 10 to 15 years, is widespread use on the part of lenders of risk-based pricing, which simply means that the lower your credit score, the higher the interest rate you're going to have to pay if you do manage to qualify for a loan. We know from our own experience, many of us, that lenders typically won't even quote you an interest rate on your loan until they've examined your credit report and your credit score. And then they'll adjust the rate to your level of risk. So it really does mean money in your pocket, depending upon the level of risk that you seem to be presenting to the lender. On this next slide here, I've included a snapshot of a Fair Isaac chart. Fair Isaac is the company that produces the FICO score. And this was produced, I think, the middle of last year, so the mortgage rates are a little higher than they are today. But they illustrate how dramatically your monthly payment can change as your credit score falls. The chart shows you that with a 760 credit score, which is considered pretty good, at the time in mid-2010, you could qualify for a 5.9% interest rate. And if it was a $300,000 mortgage loan, that translated into a monthly payment of $1,787. But if your score was 100 points lower at 650, you could only get a 7.2% interest rate, and the monthly payment would be just over $2,000. And if your score was lower still, down to 590, which is considered poor credit, 9.3% interest was the best that you could do, and the monthly payment would have been $2,500. So imagine you're buying a house, and this $300,000 loan is the loan you're taking out in order to purchase it. Same house, same loan, but a dramatic impact on monthly payment just based on the credit score that you bring to the table. Could be as much in this illustration as an $800 difference per month in the amount of payment, and that translates to tens of thousands of dollars over the life of the loan. So a bad credit score can very definitely cost you money. Third reason that we need to be concerned is that many more businesses other than lenders are using credit scores these days to make business decisions about you and to present offers to you. It's become a very important screening tool for businesses like insurance companies, especially in the property and casualty insurance world. So we're thinking of auto insurance and homeowners policies, even life insurance in some cases. But auto and homeowners insurance providers have discovered that risk scores are fairly predictive of their claim losses on the insurance policies. And the higher your risk score, the lower your claim history is likely to be. And so they're much more willing to offer you a low premium on your auto or homeowners policy if you have a high risk score. Likewise, if you have a low score, you're going to see a higher premium quote. And this, again, costs you money on a monthly basis. It's money in your pocket. Apartment rentals, certainly most large apartment complexes will pull the credit reports and the companion credit score if you're putting in an application for rental. And other sorts of businesses like cell phone providers will absolutely do it. They're offering you a service that's basically a credit service. They allow you the use of mobile phone minutes and airtime over the course of a month. and they're hoping that you'll pay them back at the end of that time. And so they act much like a creditor would, and they check your credit report. And a poor credit score may mean you can't get cell phone service. Poor credit score may mean that you need a co-signer on an apartment rental, or they could turn you down altogether. Utilities, the same story. They may require a higher deposit if there's bad information in your credit report that translates into a low credit score. Employers are increasingly looking at credit reports. This used to be the province of just employers in financial-related fields, like if you were applying to work at a bank, or perhaps be a bank teller or a frontline employee that actually works with cash. But we're finding these days that many more employers are starting to pull credit reports as an indicator of character and perhaps any ability for the employee to be compromised because of weak financial standing. And while it's mostly the credit report that they're looking at, more so than the credit score, it's nevertheless a factor and it could be a factor in a job approval decision. And that's certainly one part of your application that you don't want to have to worry about as a potential employee. So again, beware of that. So for all these reasons, credit scores are very important. One of the most important barometers of your financial health that you have, and you can manage it. And we know how you can manage it. And the fact is that you need to understand how the score works to manage it properly. Now, it does beg a question or two. First, do you understand how a credit score works? And can you explain it to somebody else? Because I'm guessing that you're probably going to need to, not only for your own personal financial management, but also because industry experts estimate that as a result of the new regulations that we're going to talk about in a few minutes, credit or bank lenders and other providers of loans are likely to be disclosing up to 500 million credit scores to consumers just in the next year. That's far, far more than are being disclosed today. And there will be different types of scores as well. So as you deal with consumers, and especially as you deal with students, the older your students, the more likely they may be applying for credit, and they may get turned down, and they may get a credit score in the mail that explains why they were turned down, and they may turn to you to try and explain what it all means. It pays now to invest in your own understanding of how the scoring models work so that you can turn around and try and make sense of it for somebody else. So let's do that. Let's take a few minutes and just spend those few minutes in a lender's shoes to try and get inside the workings of a credit scoring model. And I think this will be helpful. Let's start this way. I put up here a pie chart that illustrates the costs, the major sources of costs to running a Visa or a MasterCard program, so a bank credit card type product. This chart happens to be from 2006, that's 5 years ago, but the sizes of the wedges in the chart are pretty much the same. So, I think the data is still plenty relevant for us. Just to quickly walk around the chart, a large part, a third of the cost of running a credit card business is the cost of funds that the lender has to borrow to make available in the form of credit card loans when you use your credit card. That's about a third. The light blue wedge illustrates the 38% of their total costs that go into marketing and operations. That's preparing all of the ads that they put out there, the direct mail solicitations in mailboxes. That's all of the screening of applications that come back in to decide who to grant a credit card to or not. That's all of the customer service personnel that handle questions about billing. That's the processing of payments. All of the employees basically fall into that light blue wedge. But then the particularly important wedge for our purposes right now is that red wedge labeled charge-offs, which represent 28% of the costs of running a credit card program. In 2006, the total cost of running those programs was $87 billion. And so 28% of that, or basically almost $24–25 billion or so, was attributable to charge-offs, bad debt. Basically the credit card loans that people took out that they promised to repay but never repaid, that the bank had to write off as a loss. That's the cost the bank wants to try and manage by being more careful about who they lend to, who they open a credit account for. So the smart lender will try and reduce those loan losses by improving risk evaluation before the loan is made. And they use credit scoring to do that. To understand what credit scoring is trying to accomplish, let's walk through what I like to call the 5 C's of consumer lending. What lenders try and do is gather data on borrowers at the time of the application so that they can hopefully measure the following. The first of those C's is character. What's the borrower's character with respect to willingness to repay? And oftentimes, most of the time, lenders will try and measure this as demonstrated by the borrower's past credit history, by their track record in handling the credit that they've been granted in the past. The second C is the borrower's capacity. What's their income? How much can they afford to take on in the form of debt, and how much debt have they already taken on? How much do they already owe? Two very important determinants of the risk that the borrower brings to the transaction. Capital is the third C. How much savings do they have? What are their financial assets that they could tap in case income is interrupted and they can't pay out of current income? Collateral would be the fourth C. What's the size of the down payment they're willing to make on an auto loan or a mortgage loan? Or do they have other assets that they could pledge against the loan? That works for the lender in 2 ways. If it's a house or a car, the lender could take the house or car if the borrower refuses to pay or is unable to pay, and sell it and try and use the proceeds to pay off the rest of the loan. But more importantly, perhaps, it also gives the borrower some skin in the game. It gives them something to lose and a greater incentive to repay or to try and find a way to make the continued payment on the car loan or the home loan. And that's the value of collateral from a risk evaluation standpoint for the lender. The fifth C are just economic conditions. C for conditions. How does the economic climate influence repayment risk? We've just been through a period where the economic climate was gloomy. We've been through high, and still are in, high unemployment. And so lenders have become much more conservative in that environment because they recognize that all borrowers have a heightened risk of being unable to repay. That was on the heels of boom years in the early part of the last decade where the economy was growing very rapidly, home prices were rising, employment was strong, and lenders became less conservative and more willing to lend and use lower standards on their lending applications, loan applications, because the climate was good. And they were confident that borrowers had or were likely to have the economic ability to repay. So lenders try and take all 5 of those factors into account. Up until the 1970s, most consumer loans were based on the personal judgment of a loan officer, sort of stirring those 5 factors around in their head and based on intuition and experience with prior loans that they granted, trying to evaluate those 5 C's, estimate what the borrower's likelihood of repaying on the new loan would be. And loan officers could get pretty good at it the more experience they gathered. They would watch consumers that they'd given loans to, they'd watch how those loans performed, they'd take note of the ones that didn't perform well, where there was a default instance where the borrower didn't pay back. They'd try and look back and remember what was it about the borrower at the time of the application that should have signaled to me that they might have had repayment problems, and they'd remember that characteristic and try to apply it on future loans. And so gradually loan officers with this experience that they gained would become better at making those sorts of underwriting decisions. And that's what differentiated a good loan officer from a bad loan officer. Well, what loan officers are basically doing is noting that the past is a guide to the future. And statistical scoring models, like the FICO model, are built on that very same idea. That the premise is that the patterns that you observe in the past regarding characteristics of borrowers and accounts who pay as agreed, we'll call those good accounts, and those borrowers and accounts that pay late, we'll call those bad accounts, those characteristics are going to be repeated in future loans. So in effect, what the credit scoring model is trying to do is automate, especially the evaluation of those first 2 C's, that character and capacity dimensions of the borrower and the loan risk. The concept for the hook for the lenders is that this use of a scoring model is much better and much cheaper than having an army of loan officers out there to handle millions of loan applications, which would be the case for some of the large national creditors that we deal with. It's better for a lot of reasons. As I said, it's cheaper certainly than paying all of those loan officers. Yeah, they generate much faster decisions through the model than they do through the loan officers. The decisions have been shown to be more accurate, and they're more consistent across borrowers. So for all those reasons, lenders began to embrace credit scoring models. So just a little bit about how models work. Again, the objective of the model is to reduce what I like to call the fog of uncertainty that surrounds a pool of new loan applicants. The lender wants to try and find and use easily observable characteristics to try and sort the good borrowers from the bad borrowers. And the design objective in building a model is to create a numerical index, and now think the FICO score, that makes the borrowers who are going to exhibit good repayment behavior score higher than the borrowers who are going to exhibit bad repayment behavior. There's an analogy that I think is especially useful here, and I think many of us have probably experienced this in just daily activities. I like to think of those magazine self-tests that you often see that measure how we score in terms of compatibility with a spouse or partner, or whether or not you're a type A personality, or whether you're subject to high stress. And all of those are set up as little quizzes where you take and answer a series of questions that have been devised, and each of the answers to the questions turns out to have a little score that attaches to it, a little weight, if you will. And when you finish your 10-question quiz, you flip to the back and you take note of your answers, and you add up all the scores or the little points associated with each answer, and you get your total score on the index. And then you step back, and the index will indicate whether you're a type A personality or not. Well, that's the same idea that's used in the development of scoring models. So what I have here is a little chart that represents a hypothetical simple scoring model for, let's say, a new loan application. And let's suppose that we're a lender, and our statistical gurus have told us that there are 4 variables that are important in determining the risk of a new loan applicant, the likelihood that they're going to repay that new loan. And let's suppose those 4 variables are the type of housing, whether you own, rent, or you live with your parents, be the possible values that could take on, your household income. Let's suppose there are 3 buckets, 3 different values that could take on: less than $25,000 a year, $25,000 to $50,000 a year, and over $50,000 a year in terms of your income. And the other 2 variables perhaps are number of accounts in your credit history that are 60 days past due or worse, and the number of bank cards that you own, Visa, MasterCard products. And again, this is a hypothetical example here, but let's suppose those 4 variables matter. And let's suppose again that our statistical gurus have crunched the numbers, and they've determined weights to assign, points to assign for each value that a new applicant could possibly take on. So with respect to housing, let's suppose you have an applicant that owns their home. Well, the model would give them 38 points in the chart. Let's suppose that same applicant has an income over $50,000. Well, you get another 61 points for that, and so on for each of the other 2 variables. At the end of that process, just as in the magazine quiz, you total up the points you get for each of those 4 variables, and that is your score. This particular model, let's suppose, is set up so that the higher score means you're a better risk. You're less likely to default on a loan. But a low score means you're higher risk, more likely to default on a loan. That, in essence, is exactly what the credit scoring models do that we hear and use every day. So credit scores emerged as a commercial product for lenders for the reasons that I described a couple of slides ago. During the 1970s and the 1980s, most large national lenders invested in building their own models. They were proprietary. They were custom built to process their own loan applications. They used data from credit reports, but they also used information that the borrower provided on the loan application, and that was pretty typical. And you may remember filling out longer loan applications perhaps than what we've seen in recent years, and the creditors would be using that information combined with credit report information in order to measure your risk. Those are called custom scoring models, and many of those are still being used today by large lenders. So that's one whole class of models. But in the 1980s, there was a new idea born. It was to build a model that uses only credit report data. No application data at all, just the material, just the information that's embedded in a credit report. Model developers found that kind of model could predict default risk very accurately, and sometimes, or in many cases, didn't need borrower income for whole types of loans. That in fact, the model did better the model that used just credit report data could do better than a model that used credit report data and borrower income, and they found that to be true especially on credit cards. The advantage was that all of a sudden any lender of any size could purchase one of these credit scores on a borrower and use it to make credit decisions. Even the smallest lenders could get into the credit scoring business, or at least the use of credit scoring. So the emergence of the now ubiquitous FICO score occurred in 1989, when Fair Isaac Corporation introduced the first FICO score. The FICO score is what we often call a generic bureau score, and the translation to that is it uses only information in a credit report, nothing more. It's not like those custom models that the big creditors would build that would blend in application information, you know, what's your income, where do you live, those sorts of pieces of information along with credit report information. No. The FICO score is only credit report information, and so we call it a generic bureau score because it's built just on bureau data. In 2001, FICO began making FICO scores available to consumers through its myfico.com website, and it was the first scoring company to make any scoring product available for the general public to view. Of course, only on themselves, so you can't see other people's FICO scores. But up until that time, creditors across the country were heavily using credit scores, but consumers could never see them. So the 2001 breakthrough with FICO launching its myfico.com website was a tremendous step forward in terms of consumer disclosure and information. Up until this year, consumers have been required to pay a fee to see their FICO score. And unless you've been turned down for credit or been subject to some sort of adverse action by a creditor, which we'll talk about in a moment, you still have to pay a fee to see your credit score. Well, let's get to those conditions where you don't have to pay in a few minutes. Before we do that, let me give you a screenshot of the myfico.com website where you can go and purchase your own score. You're going to find if you start down this road, and I do encourage you to do this, just so that you can better understand your own finances as well as be prepared to answer questions from your students and others. You're going to find that purchasing a score is often not that simple. First of all, you have to pay attention to what it is that you're buying. Here on this screenshot, you'll see that FICO is willing to sell you a host of products, many of which are really boiled down to credit monitoring. Monitoring of your score, quarterly monitoring, ongoing monitoring that will send you an alert each time your credit score changes. Most of those products are available for a monthly subscription fee. But you'll notice that the very first column there in the screenshot is the place that you would go just to purchase a single time your FICO score right now. And you get the underlying credit report on which it's built. They'll sell you that for $19.95. I'm going to show you a couple of other screenshots as we go here, but the important point now is if you want to buy your FICO score, you do have to pay attention to what it is that you're actually purchasing, and you have to look at those different options fairly carefully, but you can do it. All right, so let me pause right there before we go any further and just do a little bit of comprehension check, I'll call it. There are many kinds of credit scores. FICO is just the one that happens to be most widely used by creditors. You know, at one point in the last decade, FICO was advertising on its website that 90% of the credit decisions made in the United States were based on FICO scores. Well, that's a pretty heavy penetration of the decision analysis market with respect to risk evaluation for lenders. And FICO is very proud of that. But they're not the only score out there. As we've already mentioned, many large lenders build their own scoring models, their own proprietary custom-built models. And those scores are generally unavailable to, or at least in the past, have generally been unavailable to consumers. Each of the three major credit bureaus, Experian, Equifax, and TransUnion, also builds and sells its own generic bureau score based only on credit bureau data. Experian's score in the past was called the Plus score, although I've noticed here in recent months that if you go to their website, and we'll do that here in a second, they're just simply calling it the Experian credit score these days. Still another scoring product that's a generic bureau score is the VantageScore, which was introduced in 2006. And it was developed as a joint venture by the three major credit bureaus to directly compete with FICO for creditor business. So it was always designed to be a direct major competitor to the FICO score, but it's It's new, it's small, it's growing in market share, and it's out there, and it's being used by some lenders, although FICO is still the predominantly used by lenders across the country. But that's another score that you may run into as well. All of these scores have different scales. A 650 index level on one score doesn't necessarily mean the same thing as a 650 on another model. And again, this is something you have to be aware of. Another reason that consumers would have multiple scores in addition to what I've already described is that credit reporting on the part of lenders is basically voluntary, and information about your past payment experience doesn't necessarily go to all three credit bureaus. Because the data that each of the major credit bureaus compiles about you may be different, the credit score that's built on that data will be different too. And that's true of FICO scores, Vantage scores, the Bureau's own generic scores. You, in fact, if you have a long and deep credit history, you may well have, and probably do have, 3 different FICO scores. One for your Equifax file, one for your Experian file, and one for your TransUnion file. And they may be quite different depending upon who's been reporting information about you over the years. The implication is that to get a complete picture of what lenders see about you, you need to check credit reports and scores from all 3 bureaus. But I will say to that if your information that's in your credit reports is basically very similar across the three bureaus, your scores are going to be very similar too. So seeing one score is probably just as good as seeing all 3. Now here's the screenshot that I promised you of the Experian website. And you have to navigate down into their website under products to find this particular page, but this is where they will sell you their host of products. Again, ID theft protection monthly services, credit trackers that will alert you when something's being opened. The far right-hand column there in the screenshot is the place you would go to purchase your Experian credit report and the accompanying credit score, and you could do that for $14.95. That is not a FICO score. That's the score that Experian built itself on Experian's own credit bureau data. It's still a perfectly predictive score. Lenders do use that, but it's not the FICO score, and that's just something you need to be aware of. If you set out intending to buy your FICO score, you're not going to buy it here. You're going to get your Experian score. Equifax does the same thing, and their screen, in fact, is laid out very similarly to the other 2 that we've seen. Again, just sort of continuing on with the message that pay close attention to the products being offered. You can find what you want, but you have to be very careful in scanning across these different options. And in particular, Equifax in this screenshot will sell you in the second column from the right. It will sell you your Equifax credit report and score for $15.95, but it'll also sell you your FICO score along with the underlying credit report for $19.95, which interestingly is exactly the same price that FICO would sell the FICO score to you for. So, there's a little bit of comparison shopping that's involved or is necessary, I suppose, if you're trying to explore your credit scores. Now, your Vantage score, as far as I can tell, Experian is the only bureau that will allow you to buy that directly on their site. If you go to Experian.com and navigate down through the buttons and tabs that I've listed here, personal services, then click products, then click credit report and score, you'll finally get to an option of purchasing your Vantage score, and the price on that is $7.95. So it's actually a bargain compared to the other ones that we've been viewing. Equifax and TransUnion don't appear to offer Vantage scores to consumers on their websites, so far as I could tell. Now, just as a reminder, all of these generic bureau scores are built solely on the data available from a U.S. credit report. And this screen lists for you the categories of information that are on those credit reports. The main bulk of your credit report is the account detail, the account information for every credit account that you've opened, date last reported, the date it was opened, the highest balance that you ever had on the account, your current balance, your current payment status, and your delinquency history up to 7 years. There will be a separate section on your credit report for inquiries. So when the inquiry was filed and the industry and company that actually inquired about you in the process of your applying for credit. There will be a section for public record items, which would be bankruptcy and foreclosure and other credit-related public actions, tax liens. And then a final section on collection items. So when you have accounts referred to collection agencies, they'll typically get registered here in that section. What you see in that slide in terms of information is all the information that goes into calculating your credit score. What's not in your score is anything about your income, your age, your address, or any dimension of where you live, including zip code, employment information, and gender, all absent. You may look at your credit report and find in the identity section at the top of the credit report your address, which clearly has your zip code, and it may have information about past employers, but none of that information is pulled off and calculated in a credit score, just the information in the rest of the credit report. Okay, so new disclosure rules. They mean that many more consumers are going to be exposed to credit scores. So let's talk about the implications of that. Two new regulations took effect this year from the Federal Reserve Board and the Federal Trade Commission. On January 1st, 2011, the risk-based pricing rule went into effect, and on July 21st, just a couple of months ago, the series of regulations that were triggered in last year's Wall Street Financial Reform Bill, the Dodd-Frank Act, if you recall the label, took effect that impact score disclosures. What they do together is expand disclosures in two important ways. Consumers must be given a credit score that influenced the decision to reject a loan application. If you remember in the past, when you taught lessons about credit reports, consumers are entitled to a free copy of their credit report if information from their credit report influenced a decision to turn them down or other adverse action. Now they're entitled to more than just the credit report. They're entitled to the score itself. So that's one important new disclosure. And the second, even perhaps more important piece in terms of generating millions of new disclosures is that if a lender approves a loan or line of credit for you, but with an interest rate or other terms that are less favorable than those offered to the lender's best customers, they owe you a credit score for that as well. And that's typically, I think, what's going to generate all these new disclosures, because most of us receive loans at rates that are somewhat less, somewhat higher, somewhat less favorable than the rates that the lender's best customers receive. And when that's the case, they owe us a score. All right. I've already mentioned that some industry experts estimate that up to 500 million credit scores will be disclosed in the first 12 months after these regulations go fully into effect. And so with all these scores floating around, and they may not be FICO scores that are revealed to consumers, what is it that consumers really need to understand about their credit scores to make sense of it all? Well, the first point, I think, is what's most important to remember is that it's not the absolute level that you should care about, but the relation of the score to other scores from the same model. What I mean by that is all of these scores have different scales. 650 on one model, on, say, the FICO model, doesn't translate to the same thing as a 650 on the VantageScore model. So what you want to do as a consumer is check the score provider's website for how your score compares to other consumers. What you're really asking is, or you're trying to understand is, where in the range of risk do you fall? Am I in the best 5% of all consumers out there? Am I in the worst third? Am I in the lower half, upper half, etc.? That's what you want to know. So here, for example, is a chart that shows the distribution of consumers nationally with respect to FICO scores. There's actually two dimensions to this chart. It shows where consumers were prior to the recession, so prior to 2008, and where they were in the spring of 2010. And what you'll see if you study this chart is that if you focus on the dark green bar of the right-hand bar in the chart, the dark green section, consumers who had scores of FICO scores of 750 or higher represented about 38% of all consumers in the United States. So 62% of all consumers had lower scores than the folks in the green area. If you go down to the bottom of the bar at the red area, it looks like about 25% of all consumers had scores in the 300 to 599 range. That's the lowest segment of the population. What you want to know is where your score falls in the range of that entire bar there, because that's the way creditors will view you. Are you a good risk or are you a bad risk relative to all the other applicants that they're seeing? This next chart shows the same thing with respect to Vantage scores. Now what they've done very usefully is separated out consumers into segments, 5 segments, but they've also labeled them according to grade. And so A borrowers are the folks that score highest, 900 to 990, and it looks like about 16% of the population receives an A in terms of their credit rating with respect to their Vantage score. And next up would be the B borrowers, scoring from 800 to 890. They're not quite as good as A borrowers in terms of they bring a little higher risk of payment default to the table. It's about 25% of the population is represented there, and so on down the chart. Again, what you want to know is, where does my score on this particular model fall into the distribution of all consumers who are scored with that model? The next thing that you want to keep in mind, or you want to tell people to keep in mind when they view and try and interpret their score disclosures, what are the factors that influence that particular score? You want to know that so that you can adjust your behavior accordingly. Many of you are probably already familiar with the FICO statement of what influences their score. And this pie chart, this colorful pie chart here represents the different factors that go into determination of the FICO score. The blue wedge represents payment history. That's the most important component of a FICO score. How you've paid your bills in the past. Have you been late? How long has it been since you were late, etc. How much debt do you have? The red wedge represents about 30% of your FICO score. Credit history, 15%, and on around the pie. So that gives you a pretty good idea of what's important to the FICO score and how changing different dimensions of those characteristics, how much of an influence it's likely to have on your score. The other scores, whether they're from the bureaus or the VantageScore or even a custom-built proprietary model that some creditor uses, should tell you the same thing. And in fact, they must tell you the same thing according to the new rules for disclosure. This chart displays a sample risk-based pricing credit score disclosure. This came from the Federal Reserve Bank of Philadelphia and came directly from the regulator's suggestion to lenders as to what a good disclosure might look like. And we may begin to see more of these. I personally have not seen one of these yet because the rules just went into effect. Sooner or later we will. And you'll notice on this disclosure it has 2 things that we just talked about. It has a depiction for that particular score that's being disclosed of the distribution of all scores. You'll see the little chart there on the left-hand side of the disclosure sheet that gives you, the percentage of the population that falls into various score ranges. That's very important so that you know where your score is and where you are relative to other consumers that are being scored with the same model. And at the top right of the disclosure is a box that would contain the listing of the different factors that adversely affected your credit score in that model. Those are the tools that then you can begin to focus on to try and improve your score on that model, now knowing that it had some role to play in either you being turned down for credit or getting credit on less favorable terms. The last thing that consumers need to remember, and this is nothing new, we've been advocating this for years, your score could be low due to inaccurate data in your credit report. So check your credit report from each of the bureaus at least once a year. It's very easy to do that. It's cheap to do it. In fact, it's free to do it if you use annualcreditreport.com, and you can get a free credit report from each of the bureaus once a year to be sure that the input that's going into the scoring models is really accurate and a clear depiction of you. So let me wrap up here by going through a couple of summary slides of do's and don'ts in managing your credit score. And frankly, the new score disclosures haven't changed this a bit. In fact, they probably make it easier now to reinforce these messages for your students and for other consumers. Do order your credit report and search for errors frequently. Pay all your bills on time. Your delinquency history is the most important driver of a credit score on all of these models. So whether it's a credit account or utilities or any other obligations that you have, pay them on time. You don't want an unpaid account to be turned into collection and a black mark on your credit report. If you do slip up, be patient. If you have a late payment, recognize that all negative items on the credit report roll off after 7 years by law, except for bankruptcy, which stays on for 10 years. And we know and we're told that the importance in driving your credit score calculation actually declines after as little as 2 years. So be patient if you do have a slip up. And maintain a mix of credit. Don't have just bank credit card accounts as your only source of credit. The scoring model actually gives you higher marks for having a mix of different types of credit rather than everything in one type. On the other side of the ledger, don't max out your available credit lines. That is a powerful driver down of your credit score. Don't open multiple accounts in a short period just to establish a credit history or boost your available credit. Be careful, be judicious in closing old credit card accounts. Unless you're doing it as a self-discipline to avoid using them, my recommendation is just let it go. The reason is that one of the positive factors in a person's credit report is the age of their credit file. How deep and how old is it? You get credit for having had the credit for a very long time. If you happen to have an old account that you're considering closing because you don't use it anymore, and it predates everything else on your credit history, closing it might actually lower your score because now it might look like that you don't have as long a credit history. And that's to be avoided. So again, unless you're doing it as a self-discipline tool to avoid using them, just let those old accounts ride. And don't dally when shopping for credit. You absolutely want to shop for a good loan, and we've already said that lenders will typically pull your credit report and look at your credit history before they'll quote you a loan rate. So having your credit report pulled is an inevitable part of loan shopping. So I'm not saying in any way that you shouldn't shop around for the best loan or loan rate for a car or a mortgage. But if you're going to do that, do it in a short period of time, because the credit bureaus and the scoring models are set up to count that as one single transaction and not multiple applications for credit. So I would recommend doing that in a fairly compressed time frame, maybe 30 days. Don't drag your shopping experience for a mortgage loan out over 6 months, or the models will begin to interpret that as you're buying multiple homes, and that's to be avoided. With that, I think that concludes what I want to say about the new disclosure rules, and I'm going to turn it back over to Shelly.
All right, thank you, Dr. Stanton. Staten. That is just excellent information, and it sure helps me feel empowered to go to my classroom and teach about credit reports. Sometimes, though, as a teacher, I hear wonderful information like we just did from Dr. Staten, and I think, oh my goodness, I don't have time to create a whole lesson on these new rules and all about credit reports. Luckily, though, FEFE has an awesome team that collaborates to take expert content like Dr. Staten's and create an interactive lesson plan for immediate implementation into our classrooms as teachers. For the credit report facilitation, we use a fictitious recent college graduate, and her name is Isabella. She has a sorry credit situation and may possibly not earn her dream job. The students learn the content just like we did here from Dr. Staten, and we apply it to her credit report utilizing her scenario and her tainted credit report. While doing this, they reflect on how credit decisions and behaviors can have an immediate impact on their goals. The lesson is very effective and engaging, and content retention is really shown in their assessments. All FEFE lessons offer project-based assessment, which is one of my favorite things about the curriculum. And the two options in credit reports are to have the students either create a jingle or a comic. So we'll go ahead and show you a student-created jingle right now.
Today I don't feel like doing anything. I just wanna lay in my bed. Feel like look at a credit score, so I can get a loan from the bank next door. But today I swear I'm not doing anything. I should have paid my bills to build my credit score, but my landlord just wants more. Nobody told me my score is so low. I'm gonna sell my house so I can make a little money, but my payment history ain't looking very sunny. Wish I had a financial plan. My credit is so bad. up my credit score, and I didn't get a loan from the big next door. Today I didn't do a thing, nothing at all.
So that is just a really fun way for the students to be assessed on all the content they learned on credit reports. Another awesome assessment option is for the students to create a comic. This can be done in a variety of ways, including by hand for those students that are very artistic, using PowerPoint, or using a variety of online comic creators. One students of mine really enjoy is to use Go Animate to create their comics. So let's go ahead and watch a Go Animate that was created by a pair of students in just 25 minutes.
I'm so happy I got the chance to take you out for a third date.
I am happy you asked me.
But being the third date and all, I need to get it out of the way and ask you about your credit.
What?
I apologize, but my high school personal finance teacher, Mrs. Stanton, told me it is necessary to ask about my date's credit on the third date.
All right, I can respect that. My current credit score is 380. I have missed a few payments on my car.
A few payments, more like all of them. Women these days. And now here is 3 facts about credit. 1. FreeCreditReport.com is not free. 2. Annual credit report is free. 3. Credit scores range from 300 to 850.
FEFE offers a variety of tools to help you bring technology into your classroom. These include tutorial videos, student samples, and step-by-step instructions. Step-by-step instructions are not only available for Go Animate, it's available for a lot of comic creators and a variety of Web 2.0s that help integrate personal finance into your classroom. We understand that teachers have limited class time, and because of that, FEFE has created lessons that condense facilitation into an hour or less. This curriculum type is called the Essentials, and the concept of credit reports is included in the essential options. Don't forget to check out the FEFE webinar site to see all of our additional resources and ideas in the webinar link to help you teach your students about credit reports.
Very good, Shelly. Well, let's wrap up with a few questions that have been submitted to us, and we'll just trade some of these back and forth. I suspect many of you may have the same sorts of questions about what you've just heard. So let me start with the following one. Somebody has submitted that I have students who have no credit history and have been declined approval for credit before. What do I tell my students when they ask me how they're supposed to build positive credit history if they can't get approved for credit? It's always a tough one. That's one that we've grappled with for years. It's actually become a little more different in the wake of still another set of regulations that we didn't talk about today, but were passed last year that have tightened the requirements on issuing credit cards to young people. I would say the advice that I would give these days would be first to see if you can, to the student, would be to see if they can discuss a co-signer arrangement with their parents, to see if their parents are willing to co-sign on a credit card or other kind of loan for them in order to help them build credit history, and perhaps as an opportunity to jointly learn with a dialogue, an ongoing dialogue with their parents as they use the product. Being an authorized user on a card often can convey the same sort of advantage as well. Barring that, a secured credit card is one option that's available, especially to young people. If they can't prove income, if they're or otherwise have a checkered history that's caused them to be denied in the past, if they can marshal together a cash of, say, $500, most banks, especially large banks with credit card programs, will allow them to open up a secured credit card where they put that money on deposit with the bank holds it, often in an interest-free account, and then will issue them a Visa or MasterCard type product that looks just like a regular Visa MasterCard to any merchant where it would be used, and allows them to begin building a credit history. The bank holds on to the deposit as collateral, basically, and once the customer gets to the point where they've demonstrated enough responsible payment history, you can graduate to a regular card and get your deposit back. So the secured card, although it's an obstacle in terms of pulling together sufficient funds to make that initial deposit, if you can do that, it certainly is a way to begin establishing a credit history. Another way would be maybe to obtain a small loan from a local bank or a credit union and pay it back regularly over 12 months in order to build some positive. All right, Shelly, would you like to take the next one?
Sure. Thanks, Dr. Staten. I'm glad you answered that question because it is definitely one that comes up in the classroom. Another question we have here is, how do you respond to students who do not plan to use credit? And this is another one that often comes up in the classroom. And a suggestion I have is to just ask the child probing questions on why they don't want to use credit, and just have them make a list of the pros and cons of having no credit versus a bad credit history. And really empower them to feel confident in their choice, but be sure that they understand the implications of what using absolutely no credit can mean for their future. So Dr. Staten, can you help us out and answer another one?
Sure. This question is the following. When you have a credit card and you have an authorized user, is the authorized user building their credit history as well? And can someone under 18 be added as an authorized user? So two parts. That's the main purpose of an authorized user arrangement, is to allow another person, obviously, access to the credit card, but it does get reported on that person's credit history. The difference between that and a cosigner is that the authorized user doesn't have a legal responsibility to repay on the account. Whether or not it can be issued to somebody under 18, I believe the answer is yes, but I'm not entirely certain about that. But certainly, authorized user status is one way to have positive credit history, assuming the account is paid on time as agreed, to have that account history be built into your credit history, and it helps build that history. So yes, it's an effective tool. Let me take another one here. Can individuals under 18 even have a credit history, and can they check their credit report? Well, as we know, 18 is the legal contracting age, and most lenders will not knowingly enter into a credit arrangement with somebody younger than 18. But it has happened, and it has happened often by accident. Sometimes it's happened without the person who is under 18 even knowing that an account has been opened in their name. And so the answer to this question is very much yes. You may have a credit history, and yes, no matter how old you are, you can always check to see if you have a credit report. And it could be instructive. Odds are that people under 18, if they go through the process through one of the bureaus or even myfico.com to obtain their credit report, they'll find that they don't have one. But once in a while, and we've seen studies that demonstrate this, people will discover that in fact they do have a credit history. And it could be for a whole host of reasons, and sadly some of those reasons are parents that open up accounts in their children's name when their own credit is tapped out, and they need the opportunity to use somebody that has a clean credit history as a way to expand their own credit opportunities, and we've seen that happen before. So, it does pay to check, I suppose, even at a young age, although the odds that you're going to have something in your credit report are probably small if you're younger than 18. Shelley?
Thanks, Mike. That's a great question, too. I'm sure glad you're answering these for me. A question we have about pedagogy says, I have learners with a large variance in reading levels and speeds. How do you manage this difference in reading skills for the news headline activity? And that obviously is pretty reading intensive. And there's a lot of ways to still use this with students with low reading abilities. One way that I use this activity still with low readers is to give them the article the day before, have them take it home and read it, and give them the option to ask me any questions before I put them in the group. Especially with low readers, I make sure they're in a group that they're comfortable with so that they're not made fun of by their peers. We have a lot of master educators that also use the same activity with a video clip. So those are all ways to still engage those low readers into the news headline activity.
Great.
Go ahead, Dr. Staten. Yeah.
Okay, I'll take a couple here.
Okay.
Question: does requesting a credit score or report reflect as an inquiry on future reports? That's an excellent question, and there's a common misconception out there. Consumers can request their credit report anytime without penalty with respect to their credit scores. When a consumer requests their own credit report, it's called a soft inquiry or a soft pull. And those are tracked by the credit bureau, and they're required to do that by law, but they're tracked in a separate category. Credit scoring models only utilize what we call hard pulls or hard inquiries from businesses, other creditors with whom the consumer has some sort of relationship, with whom the consumer is in the process of applying for credit. Those are the inquiries that affect your credit score. So when you go to annualcreditreport.com and you look in the inquiry field on your credit report, you'll find two categories. You'll find the soft inquiry and the hard inquiry fields. The record of your own pull of your credit report will show up there, but that doesn't count against your credit score. So that in no way should inhibit you from checking your credit report and checking it as often as you like. Right? Another question: is a debit card considered a secure form of credit, and does it help me build my credit history? And the answer to that is no. Debit card product is not a credit product. It's linked directly to your checking accounts, and so all transactions occur either in real time or within a day or two of when you use the debit card at a point of sale, and the money is extracted directly from your checking account. There is no billing in the form of credit card statements as there would be with a credit card transaction. As a consequence, debit card ownership doesn't show up on a credit report. So many students often have the misconception that because they're using a plastic payment product, because it happens to just be plastic and it has a Visa card logo on it, that it's helping them build credit history, and that's not the case. If the plastic payment product with the Visa logo on it happens to be a check card from a bank or a debit card, check card is what many banks often call them, it's not being reported to the credit bureau. It's not helping them with a credit history. It's a very useful tool for making transactions, but it doesn't build a credit history. Shelley?
Yeah, thanks, Mike. That is definitely one the kids think they are building credit history for, so I'm glad that that was brought up today. Another pedagogy question is, do you have tips for computer lab management if students are creating one of the electronic comic options? And I sure do. And the first tip I have is to have the students make their script on paper or in a Word document before they get on the Go Animate or other comic creator site. This way I can assess their content even if the technology glitches, which we know happens a lot. Another thing I always do with comic creators or Web 2.0s that are really engaging for the students is I give them a set time limit before they ever start on the computer, because a lot of them will spend too much time with the animations and all of the looks rather than the content. So I always have them put the content in first and give them the time limit up front. And then a last tip for all Web 2.0s, including the comic one, is to have students log in with a teacher account so that you can have all of the creations in one area for monitoring, grading, and just to share so all of the kids can see their peers' creations. Okay, Dr. Staten, teach us some more. Here, I'm ready.
All right, one last question. Can we still get a free credit report each year from each of the bureaus? And is there something down the road that will allow consumers to get a free copy of their credit score? Two parts to that. Yes, absolutely, you can still get a free credit report each year from each of the three major credit bureaus, and you can do that through annualcreditreport.com. I believe that's the only way you can do it. That's the website that they were tasked by Congress to set up to facilitate that. One strategy for using that free report is actually to get ongoing information through the year about what's in your file would be to, in the first 4 months of the year, pick one of the bureaus and get your free report, say, from TransUnion. And then 3 or 4 months later, pick a second bureau like Experian and get your free credit report from them. And then to close out the year, 3 or 4 months after that, get it from Equifax as your final report. That way you've obtained reports from all three bureaus, but you've spread it out over the year so that if something is added to your files from, say, a national lender that's reporting to all three bureaus, you're going to pick up on it without having to wait a whole year until you draw your next grievance. So that's what I would suggest is that strategy. As far as scores, this new disclosure rule was a major step forward for making it easier for consumers and certainly less costly for consumers to discover their credit scores. It's not perfect. It doesn't allow you to log into myfico.com any old time and pull down your FICO score at will. You can only do it if you've been subject to some sort of adverse action, either being turned down for credit or being offered credit terms on terms that are less favorable than those offered to the lender's best customers. But that impacts a lot of us, and it will certainly raise awareness on the part of consumers of credit scores. And I think the tension there in Congress, I mean, many consumer advocates have argued for years that the bureaus and scorecard providers ought to be required to allow consumers to peek at their own scores for no fee. And the tension, the pushback they get from the industry on that is that there are millions of dollars of intellectual capital and proprietary knowledge that go into building these scoring models, and the model builders are rightly afraid of giving that away for free. And sort of letting the genie out of the bottle, so to speak, in terms of their proprietary secrets, in terms of how those models are put together. So, you know, they've pushed back and resisted, and so far Congress has only been willing to take this important step here that's been taken this last year to broaden the disclosures to those folks who've been adversely impacted by something in their score. Beyond that, I'm guessing that we'll probably have to wait several years to see how the new score disclosures play, basically, what sort of consumer reaction we get to it, whether it's moving the ball forward in terms of consumer awareness of the factors that drive scores. And then it may be time to revisit it to see if additional regulation with respect to scores and possibly further disclosure of scores at a lower price is worthwhile or not. But I'm guessing that this is what we're going to see and what we're going to live with and adjust to for the next several years. All right. Well, we certainly appreciate you spending some time with us today in learning about credit reports and credit scores and the new disclosures and how you can pull this information into your classroom for your students. We would like for you to continue asking questions and offering opinions through the forum that's available on the FEFE website. We can continue this discussion throughout the fall, and not only with us, but with your fellow teachers around the country. Certainly take advantage of the FEFE website to access a variety of other resources that are useful for this topic and a host of other topics related to personal finance and would be valuable to your classes. And tell us what you think. You have the opportunity to, on the website for this webinar, to take a short survey and tell us what you liked and didn't like about the webinar format. We really do look at that information and value your input, and we use it to shape the way that we construct these webinars that we plan to offer in the future. Please join us again for future webinars. We do plan another one this fall on credit cards as the topic, and credit cards and new regulations in the wake of the financial crisis of 3 years ago. We do plan additional contests that you and your students may be interested in entering, so stay attuned to that. And plan even further ahead to attend the FEFE National Training event that we do every summer here in Tucson. It's a fantastic 3.5-day event. Next summer it'll be June 25th through June 28th. And we'd love to have you here along with 100, 150 of your colleagues from around the country for an in-depth treatment of how you move this material into your classrooms. So with that, I want to thank Shelly. I want to thank everybody who helped participate in putting this webinar together. Thank all of you for viewing it, and please join us again. Bye-bye.